In this video, I'm going to go over how you should not invest in 2023 and some general investing mistakes that I see beginners making. For 2023 specifically, we're going to have higher interest rates. The inflation is still crazy through the roof, and there's the threat of an impending recession. Since things are going to be volatile, you're going to want to keep your emotions in check. What's up, guys? If you're new here, my name is Humphrey. I'm a former financial advisor, and I make finance videos on YouTube. And the first thing that you should not be doing in 2023 is to panic sell. This is one of the biggest glaring mistakes that I see all skill levels of investing doing, and if you think that you're not the type to panic sell, just listen to this. A study was done in 2021 that took into account 650,000 individual brokerage accounts. They found that the average person who tends to panic sell has one of the four following characteristics. So either they were a male, they were over the age of 45, they were married, or they had dependents. Now, the key characteristic that was similar among all of those groups of people was that they declared themselves as excellent investors. In other words, if you thought you were really good at investing, you were actually the one that was most likely to panic sell all of your investments, and a panic sell is described as you selling off 90% or more of your assets within a single month. The worst part of all this is that 30.9% of the investors who panic sell never actually reinvest or re-enter the market at any time. And that can be really devastating because according to Bank of America, some of the best returns may follow some of the biggest dips. You can see in this table since 1930, missing the S&P 500's 10 best performing days every decade led to a total return of 28%. However, someone who stayed invested through the ups and downs may have had a 17,715% return. Here's another example in the decade of 2010. If you missed the best 10 days, the market returned 95% for you. But if you had just stayed invested, you would have gotten twice that much, or 190% in the market. While the paper concluded that, according to data, panic selling wasn't the 100% worst thing an investor could do, what it would lead to more often than not is more negative emotions associated with investing in general. That's because you're probably emotionally scarred from getting out of the market by panic selling. So imagine you lose 50% of your entire portfolio by panic selling, and then all of a sudden, okay, you want to re-enter the market now, but you're hesitant and you're anxious because what if you re-enter the market and it goes down even further? Now, the sensible thing to do, according to Warren Buffett, especially in a volatile year like 2023, is to be greedy when others are fearful and to be fearful when others are greedy. Since we are expecting a lot of volatility in 2023, there will be multiple points throughout the year where you might succumb to your emotions and might think about panic selling, but I promise you, if you just stay invested for the long term and keep a long-term perspective, it's better that you don't panic sell. So according to the data, if you do stay invested, your portfolio is going to be a lot better off for the long term. I mean, you just saw in that table that if you missed some of the best days, that your return is going to be literally halved. That's the thing that I want to impart with you guys today, which is maybe in 10 or 20 years from now, if you look back at the stock prices of today, they're going to seem a lot lower in comparison. So remember, guys, have a long-term mindset and keep at it. The second thing that I would not invest in, or at least be hesitant to invest in 2023, are growth stocks. In 2023, we're going to be expecting more federal interest rate hikes, which means that the federal funds rate is going to go up at least in the first half of 2023. Growth stocks, for anyone new out there to investing, is basically a company that is using all of their capital to grow and expand as quickly as possible. A famous growth stock right now is Tesla. Now, when you think of Tesla, you don't really think of it as a growthy stock because it's been around for quite a long time. However, the truth is that Tesla has been trying to innovate in the electric vehicle space, as well as they're trying to disrupt all other types of industries. They keep experimenting with different products, and it's still a stock that's trying to grow faster than the average stable company out there. Now, why should you think twice about investing in growth stocks in 2023? A huge reason has to do with the fact that growth stocks really leverage debt and borrowing. Because of interest rates going up overall in 2023, a lot of growth stocks are going to be hesitant to take out loans because the interest on those loans is going to be much higher. So therefore, they're not going to leverage as much borrowing, and therefore their growth is going to be a lot smaller. There are going to be some companies that do really well in a higher interest rate environment. And if you are interested in learning what those companies are, you can check out my latest video on how Warren Buffett would invest in 2023 because he goes over that exact scenario. For example, consumer staple stocks and financial stocks tend to do well in a higher interest rate environment, as well as other stocks that don't rely on economic growth, such as insurance. All right, the third biggest mistake of investing in 2023 is you're going to be keeping your cash in a checking account that is not yielding you higher than 0.1 or 0.2% on your money. If you've seen some of my videos, you know that it's okay to keep some cash on the sidelines for investing opportunities or any big opportunities that you're going to see in 2023. However, if you have your cash just sitting in a big bank, for example, like a Chase or a Wells Fargo, and it's not earning you any interest, you are losing a ton of money on your deposit. Because interest rates from the Federal Reserve are so high for the foreseeable future, there's a simple and easy way to get 3.75, even 4 or 4.25% on your money while it sits safely in a bank account. Most people are just too lazy to move their money out of a big bank checking account into a high yield savings, and according to a recent discovery, Americans are leaving $42 billion of interest on the table per quarter because they refuse to get any amount of high yield savings account. That's absolutely crazy to me. So according to this study, the 5 banks, Bank of America, Citi, JP Morgan, Wells Fargo, and Bancorp, paid an average of 0.4% interest on their consumer deposits. That's about 1/10 of the interest rate that you could get from a high yield savings account. For example, Ally Bank, Wealthfront, and even Robinhood is even offering close to 4% right now, and it's all FDIC insured. If you have any extra cash that's laying around, you want to make sure you move that money into a high yield savings account as soon as possible, because let's put it this way, on a $10,000 deposit, for example, that's going to be around $400 of free money that you're leaving on the table, or off the table, or whatever the expression is, every single year. If you're looking for more options on where to open a high yield savings account, you can literally just Google high yield savings account where to open, and you'll be able to find a lot of options, and hopefully one that's more comfortable for you. Just make sure that it has FDIC insurance so that you are insured in case the institution ever fails. All right, the next way that you should not invest in 2023 is to copy your friends without understanding the basis for that investment. Just like in school, you don't want to copy your friends' homework because you're not going to learn anything about the actual material. And same thing with investing. If you just blindly copy your friends' investments, it could actually be a lot worse because you could lose a lot of money. Especially in 2023, we're going to get a lot of negative headlines in the news. So people are going to say that there's going to be the fear of a recession, the economy is collapsing, etc., etc. And whenever there's fear, there's going to be bad actors that are trying to capitalize on your fear and your emotions. If you follow a lot of people on social media, you might log on to Instagram one day in 2023 when the market is having a bad day, and you see someone post their trade, and you might be tempted to copy their trade. However, if you don't understand the reason why they are making that trade or why you are blindly following that trade, you're just asking for a ton of trouble. Because the thing is that investing is a super personal process. You need to assess your own age, your own risk tolerance, and your own time horizon, and what investments would suit into that strategy. For example, I have a friend, he has his house paid off, he has his 401k maxed every single year, and he still has a $200,000 portfolio in his Charles Schwab account that he just plays around with. He'll post about it on his Instagram, he'll buy meme stocks, he'll buy random option plays, he'll buy random commodities. And the thing is that if he lost his $200,000, he would be financially no different than he is today. But you might only have $200,000 to your name in total. And if you copied my friend's investing plays, you would just be asking for a ton of financial ruin. The main takeaway I'm trying to teach you in 2023 is that emotions are going to be supercharged. So especially with the media headlines. So you want to make sure that you're investing in things that you fully understand, because even if you invest in something you fully understand and it fails, at least you learn something about what investment decision you just made. I also want to bring up that you are accountable for your actions when it comes to investing. So even though you see your friends post about something on social media, it's ultimately you that pulls the trigger at the end of the day. So don't listen to everybody and don't listen to the noise. Really make that decision for yourself, and you're going to be a lot better of an investor in the long term. The number 5 thing that I would not do when it comes to investing in 2023 is to try to time the market. And you're going to see a lot of investors try to time the market in 2023, especially if there's volatility or a lot of big dips. Here's an interesting study from the Schwab Center for Financial Research. It compares 5 investing styles of 5 hypothetical long-term investors. Each of these investors is given $2,000 at the beginning of every year for 20 years, starting in 2000 and ending in 2020. In this hypothetical situation, each person has a crystal ball, so they know exactly what the market will be throughout the year. The first person times the market perfectly, which means that he or she buys in at the lowest point every single year, and some years that might not even be till September or October, but they do buy at the lowest point every single year. The second person just invests immediately whenever they receive the $2,000 every year. The third person dollar cost averages into the market. The fourth person has the worst timing possible, as in they buy at the top every single year. And the last person just stays in cash. Now, who do you think did the best in terms of performance? If you said the first person, which is the person that was able to time it perfectly every single year, that would actually be the correct answer, but that's kind of an unrealistic realistic thing because they were absolutely perfect in their timing of the market. The person with perfect timing had a portfolio size of 151K over 20 years, but right behind him was investing immediately and dollar cost averaging, both at around 135,000. Even the person who had poor timing had $121,000 at the end of 20 years, but the worst case scenario was to leave your investment in cash. The takeaway here is that perfect timing is statistically impossible, so it's likely that we're not going to get that $151,000 result, but investing immediately or dollar cost averaging, those actually produce pretty similar results, and it's going to be your next best option. I personally like dollar cost averaging over time, especially weekly or every other week. That way, if there are dips or even spikes in the equity that I'm trying to buy, at least I'm getting an average price that's consistent over time. So the old adage, time in the market beats time in the market, still rings true in this scenario, especially it's backed up by data, and hell, even bad timing is better than keeping it in cash. The only scenarios where you want to keep cash on the sidelines is that if you have a big purchase coming up in the next 1 or 2 years, for example, a fancy wedding, or maybe you're trying to buy a house, you might not want to risk it in the market. I do want to take this time to let you guys know that I have a free newsletter called Hump Days. It drops every single Wednesday and Sunday, and we cover business news and tech news. So if you'd like to sign up for that, the link will be in the description below. I hope that you guys enjoyed this video on how not to invest in 2023. Let me know in the comments what you guys thought, and I'll see you guys in the next video. Thank you for being here. Peace.